Want to learn the essential life and health insurance topics quickly? This slides guide is packed with high-priority points to help you study smarter, not longer. Now, let's dive into retirement plans. Retirement planning involves both qualified and non-qualified plans, individual retirement accounts, IRAs, rollovers, and employer-sponsored programs. The key purpose is to provide long-term financial security and income replacement during retirement while taking advantage of tax benefits. Qualified versus non-qualified plans. Qualified plans are IRS approved and must comply with federal rules under ERISA. They cannot favor highly paid employees, must be written and permanent, and communicated to all participants. The main tax benefits are that employer contributions are tax-deductible, employee contributions are pre-tax, and growth is tax-deferred. Non-qualified plans, on the other hand, are not IRS approved, can discriminate, for example, offered only to executives, contributions are not tax-deductible, but growth is still tax-deferred. For instance, a CEO-only deferred compensation plan is non-qualified, whereas a company-wide 401k is a qualified plan. Background question: why would a company choose a non-qualified plan even though it lacks tax benefits? Typically, it allows them to provide additional incentives to key employees without violating discrimination rules. ERISA and participation requirements. The Employee Retirement Income Security Act, ERISA, establishes minimum standards for retirement plans, including reporting, disclosure, fiduciary duties, and vesting standards that protect employee rights. Participation rules generally require coverage of employees aged 21 or older with at least 1 year of service. The top-heavy rule states that if over 60% of plan assets are allocated to key employees, the employer must contribute more to other participants to balance benefits. Other participants to balance benefits. Withdrawals and taxation. Withdrawals from retirement plans are taxed as ordinary income. Withdrawals before age 59.5 are generally subject to a 10% penalty unless an exception applies, such as death, disability, divorce, loans, rollovers, or substantially equal payments for life. Required minimum distributions, RMDs, must begin by April 1 following the year the participant reaches age 70.5, with a 50% excise tax for failure to comply. Employer-sponsored plans. Employer plans fall into two categories: defined benefit (DB) and defined contribution (DC). Defined benefit plans, often called pensions, guarantee a specific benefit at retirement, usually based on salary and years of service. The employer bears the investment risk. Defined contribution plans provide benefits based on contributions and investment performance. Contribution limits apply, and the employee bears the investment risk. Defined contribution examples. Common examples include profit-sharing plans, where contributions vary with company profits, money purchase plans with fixed annual contributions, target benefit plans that combine DC and pension features, and stock bonus plans, where contributions are made in company stock. For example, if company profits increase, profit-sharing contributions increase, and vice versa. 401k and 403b plans. 401k plans allow employees to defer salary pre-tax, with potential employer matching. 403b plans are for employees of schools, churches, and charities, and function similarly. Background question: why might an employee choose a Roth 401k instead of a pre-tax 401k? The answer is that Roth contributions are after tax, but withdrawals in retirement are tax-free, providing potential long-term tax savings. Small employer plans. Small employer plans include SEPs, simple, and Keogh/HR10 plans. SEPs allow employers to contribute up to 25% of employee compensation to IRAs. Simple plans are for employers with 100 or fewer employees, requiring either matching or 2% non-elective contributions. Keogh plans are designed for self-employed individuals, with defined contribution maximums up to $49,000 and defined benefit maximums up to $195,000. Individual retirement accounts, IRAs. Traditional IRAs allow tax-deductible contributions depending on adjusted gross income, with tax-deferred growth. Early withdrawals incur a 10% penalty except for certain exceptions, including death, disability, first-time homebuyer expenses, education, medical expenses, or unemployment health insurance. RMDs must begin at age 70 and a half. Roth IRAs. Roth IRAs differ in that contributions are not deductible, but growth is tax-free. Withdrawals are tax-free if the account is at least 5 years old and the owner is 59 and a half or older, disabled, deceased, or using up to $10,000 for a first-time home purchase. There are no RMDs for Roth IRA owners. For example, investing $5,000 per year starting at age 25 could yield tax-free withdrawals at age 60. Rollovers. Rollovers allow tax-free movement of funds between retirement accounts. They must be completed within 60 days if the employee receives the funds personally, otherwise, 20% withholding applies. Trustee-to-trustee transfers avoid withholding. Surviving spouses can roll inherited funds into their own IRAs. Pension Protection Act, 2006. The Act strengthened employer pensions and encouraged employee savings. Key provisions include auto-enrollment in 401k plans, better disclosure, higher contribution limits, fewer underfunded plans, military personnel allowed penalty-free withdrawals, and easier portability between plans.